Okay folks, today's video I want to talk about a very important topic when it comes to trading. It basically applies to all forms of electronic trading, all trading entities, but I am going to focus here just on the Forex market. And the topic is slippage. It really can be the most annoying aspect of the Forex market. It can leave the uneducated trader bewildered and frustrated. Believe me, I know, I am talking from experience here. Back in the day, many years ago, I believe slippage was the #1 reason why I had my single biggest ever loss on one trade in the markets. It was the New Zealand dollar against the Japanese yen. I live here in London. I went to bed, trade was nicely in profit. I'm using controlled risk management, maximum 1% per trade at that time. Woke up the next morning, my account was down 30% on one single trade. I had no idea what caused this. At the time, I was frustrated, bewildered. That is an understatement. And slippage, I think, is also the #1 reason. It's certainly one of the biggest complaints that I have to investigate from traders that think they're being scammed by their broker. Their trades are stopped out when prices didn't actually hit their stop, or they fail to have their profit targets hit when prices clearly hit their profit target on the chart. But unfortunately, that is a fact of life when it comes to electronic trading. So you need to understand about slippage, how it can affect your trading, and how best to avoid slippage in certain circumstances. Come on, let's have a look. Okay, so let's start off with a simple definition of what slippage is. Now, this is my definition. I think they're pretty standard. Slippage is the difference between the expected price of a trade, that's basically what you think you're getting into the trade at, and the actual price when the price is executed. Let me explain. This is a simple trade ticket. Now, I pulled this from the MT4 platform. MT4, MT5, pretty similar. In fact, most trading platforms, trade tickets will look very similar, normally consisting of two prices, the bid price and the asking price. Now, if I want to buy the market, that basically means I want the market to go up, then I'll be looking to buy at market. Remember, this is market execution as opposed to a pending order. More about that in a moment. If I buy at market, I'm expecting to buy the market at this price here. I'm expecting the fill to come back at 64.2. Okay, that might not happen. Markets are moving all the time. Spreads are moving all the time. Might not happen. I might get a very different price than what I see on the screen. And that is because of slippage. And the same, if I want to sell a market, I might want to expect this market to go down in value. So I'll be looking to sell a market. I'm expecting to get that price there. But it won't happen because here, the spread is always changing. And of course, price is always changing as well. Clear? Let me explain further. So here you'll see the euro against the Oz. Ask price 1.6012 and the bid price 1.6008. Now this would constitute a 4 pip spread. Spread is very important when it comes to slippage. More about that in a moment. So I think this market's going up. I look at the asking price. I want to place an instant execution market order. I'm expecting the fill to come back at that price there. But when the fill comes back, I get filled at 1.6014. I've succumbed to a 2 pip slippage. These slippages can add up. Now, if you're trading one standard contract in this currency pair, then that would constitute $20 more, 20 Australian dollars more, to buy that currency pair. Because it's cost me, this is known as negative slippage. But slippage can work for you as well, depending, of course, on how honest your broker is. In the same price example, let's assume now I want to buy here at 6012, but the fill comes back at 6010. So that's 2 pip slippage, but it's actually saved me money. This is positive slippage. Doesn't often happen, but it does. It can be very, very nice. So slippage can work for you and against you, depending, of course, on how honest your broker is. Now, unfortunately, there's no real way to avoid slippage when it comes to electronic trading. It's a simple fact of life. However, the only real way to avoid slippage is to place pending orders. Now, pending orders are orders placed below the market in the case of a buy order, or above the market in the case of a sell order. So you need the price of the market to come to your price before the trade is executed, and will only execute at that price. However, that also has its consequences as well. Now, I just want to explain to you exactly something that you may see in your trading going forward. Here is an example of the price 6008 is the bid, ask is 6012. Let's assume you want to buy this market, but you want the market to come down to your pending buy limit order at 6002. Let's assume now the market does come back down. And in fact, the market comes back down to 6000, 6004. Remember, the price you see on the chart, be it the bar chart or the candlestick chart, that usually, certainly in the case of MT4 and MT5, is the bid price. And that is the price that you see on the chart. So you'll see on the chart, hey, price is now 6000. I should have executed my trade because my buying price is slightly higher. But because the asking price has not come down to your buy limit order, you're not going to get filled. So often traders will come to me and say, I had my buy limit order in there, but it didn't fill, although I saw the print going through on the screen. That's why, because if you're placing a bending buy limit order, the asking price has to come down to your pending limit. And of course, that is a consequence of having a spread in the market. And of course, the wider the spread, the more disadvantaged you may be in getting your trade filled. And of course, if you're looking to sell, the exact opposite would be the case using the pending sell limit orders. But now you know why you may see a print on the screen not get filled. Okay, so now let's look at slippage and the stop loss. Okay, so look at this example. We've got price showing ask 6012, bid 6008. Okay, now this is a 4 pip spread. Let's assume now I want to buy this market. I take a long trade at 6012 by hitting a market execution, and I don't get slipped, I get the fill at that price. I place my stop order at 6002. Let's assume markets don't change. Price isn't moving because more buyers and sellers. However, the spread widens. The spread has now widened for whatever reason out to 12 pips. That basically takes my bid down below the stop price. That basically means my stop order is going to be triggered. My sell stop is going to be triggered, executing a sell trade at a market price. And the market price might be well below here. It might not be any buy orders at that price. It might be much further down. So I'm going to get a fill much lower down. Orders will fill at the next available bid. Very, very important. The spread's widened, it's triggered my stop, and I'm going to get filled at the next available bid, which could be a long, long way away. Often traders will come to me and say, I can't believe I got stopped out. I was only risking 1% of the account. And indeed, I ended up losing 3 or 4%. And often that is the case because the spread's widened, it's taken out their stop, and the next available bid was much lower down. So be aware of that. One of the most common questions or concerns that I get on my desk. And now let's look at an example of a sell trade. So I want to sell here, looking at hitting the bid. I sell at 6008, no slippage there. As with any good trader, placing your stops at the same time. My stop is above the market at 6014. 4 pip spread. Let's assume now markets don't move, but big numbers released. Some data releases move the market spread, and that spread has now widened to 12 pips. The ask price has now driven above my stop level. That is going to execute my buy stop to get out of that losing trade. But it won't execute necessarily at 6020. It will execute at the next available ask price, which could be much, much higher. So be aware of that. Now, at least you know why. Sometimes your stops don't get filled at the desired price, because stops, once triggered, will fill as a market order, and that is where slippage can really hurt you and your trading account, which is why I always suggest you follow some strict rules or understand slippage, so hopefully you can avoid certain conditions in the future. More about that in a moment, because of course that is why you're here. Let's now look at slippage and take profit targets. Let's assume on this trade I have sold short. That means I think the market is going down. Sold short at 6020, and my profit target here is going to be 6010. So I've sold here at the bid, and my profit target is down here. Now moving on, what's happened here? The spread has made the bid price now fall below my take profit target. Yeah. Remember, the price you see on the screen, on the chart, on the candlestick chart, is going to be this price. So naturally, you're going to think, hey, it just hit 6008. I should be out of that trade. I should have taken my profits. But because the asking price, 6012, because that's obviously where you'd have to buy back your position to cover that short trade, hasn't fallen to your take profit target, in which case you're not going to get the buy order filled. So slippage is directly linked to the spread, and the spread is constantly changing. Okay, so this is a typical order ticket that I've just pulled from MT4. This is a live market. These are live prices at the time of recording. What I want you to look here is down the left-hand side. You'll see the ask line and the bid line, how these will narrow on occasions and widen at occasions, all based on a number of factors. This is the euro against the US dollar, the most actively traded currency pair on the planet. You'll see here the spread can tighten in quite closely on this broker platform. Different platforms, different brokers, of course, have different spreads in there. But of course, if you're using a currency pair that maybe is not so widely traded, like the Australian against the Swiss or so forth, you'll see the spread there can be quite wide, and it can get wider as well. The spread, as I say, is constantly changing. And indeed, you can go out to some of the exotics. Let's see if I pick here the US dollar against the SEK. Okay, see how this spread can widen and can narrow on occasions as well, depending on market liquidity. So remember, the price you see on the chart, the price you see on the candlesticks or on the bar chart is always going to be this price here. It's going to be the bid price. Okay, so let's finally just talk about where slippage occurs most. And if you understand where slippage occurs most, then you're going to be better equipped to maybe avoid slippage as much as possible. Okay, so first up, slippage with a low liquidity pool and or wide spreads. Remember, a lot of traders blame their broker. You need to make sure that your broker has access to a large liquidity pool, because the large liquidity pool will basically reduce the size of the spread. Remember, brokers in the business, they've got to make money. And normally they make money in two main ways. They make money on commission, or they make money on the spread. You need to factor in that when deciding what broker to use. Are you going to use a broker with wide spreads and less commission, or more commission and tighter spreads? That is an important factor. It is a topic on its own as well. I do discuss that with all our members on a regular basis. So check out the broker. Again, this will be dependent on the style of trading that you're doing. If you're scalping on a 5-minute chart, then you may want to have a broker with really tight spreads, so you're not going to get whipsawed about with slippage. So the liquidity pool is really important, and the brokers cost or charges, how they're going to implement those. The other thing I want to talk about are volatile market conditions. Market conditions, but they're going like this, going like that at a time. That is going to have an effect on the spread. The spread is going to widen as volatility increases. If you are trading in volatile periods, then you're more likely to get slipped. So be aware of that. Again, does depend on the style of trading that you are adopting. Minors and exotics. This is very important. I just highlighted a few there on that live ticket. But the spreads vary massively on the currency pairs that you are trading. So for example, the most actively currency trading pair on the planet is the euro against the US dollar. Now, because it's so active, that means it has many more market participants. Because that is the case, the spread is very, very tight, usually. Sometimes brokers will offer pretty much almost zero spread at all, because the liquidity is so high. Some trading currency pairs like the exotics, or some even of the minors, which are anything that's traded not involving the US dollar, those spreads can widen as well. If you're trading the Swiss against the Singapore dollar, for example, not many people are trading that, let's be fair. That means the spread is going to be wider. That means you're more likely to get slipped on some of your trades, again depending on the strategies that you are trading. The speed of execution, very important. If you're based in some part of the world and your broker is in the other side of the world, there is going to be a time delay. We call it latency from placing the buy or sell button with your mouse to actually hitting the broker's servers. So that delay could cause you to have slippage as well. So that is worth factoring in. Always check out the latency of the broker that you're looking to trade and the currency pairs that you're looking to trade, because that can have an impact on the slippage as well. Times of the day. Now, I often get asked this: when is the best time to trade the Forex market? Well, the obvious answer is when most participants are in the market. More liquidity, tighter spreads. So that usually happens during the overlap. So when the Asian session's overlapping the European session, or the end of the US session that's overlapping the start of the Asian session, these are times of much higher liquidity. Now, trading in the dead of night during the Australian time zone, the Asian session, when nothing else is open, maybe these times are not the best times to be trading if you're trading higher frequency trading on the lower time frames, because the spreads tend to widen. And data releases. This is very important because throughout the trading week, as you know, we have data releases, be it inflation data or job numbers, non-farm payroll. Generally speaking, when we have a data release, liquidity dries up and the broker's spreads widen. Now, this is often the case. I've seen it time and time again. Brokers widening the spreads because of liquidity, and you're getting stopped out and the market hasn't even come close to your stop level because of the thin liquidity. So in times of data releases, the spreads widen. These are high volatile periods and slippage occurs more often there. 5 p.m. Eastern Standard Time. Every daily candle closes at some point. The most actively traded currency markets, I think, trade off the 5 p.m. New York close. Often you'll see markets widen their spreads during the rollover time. So be aware of when your broker rolls over its daily candle, because again, that can impact your slippage as well. It certainly impacts the spreads. Again, it depends on the strategy that you are trading. So of course, there are many things to consider when looking at spreads and therefore slippage when trading. So when deciding on your trading style, your strategy, you need to be aware of these factors so you can factor it in to your trading plan. It's very important you understand the impacts of slippage and how it can affect your trading. Now, the obvious answer to avoid slippage altogether is to trade the higher time frames. If you're trading higher time frames, it means your stops are going to be much wider, so you're not going to be so susceptible to those big anomalies when the spread widens out. But of course, not everyone wants to trade the higher time frames. People want to trade the lower time frames. That's absolutely fine. I trade lower time frames myself as well, but I do avoid certain circumstances where I know the spreads are going to widen and my stop is more likely to be triggered. At least now I know, of course, that sometimes my take profit target won't always be hit just because the candlestick trades through it, and sometimes I know I'm going to get stopped out when really the price didn't actually get to my stop. Okay, I hope you found that useful. At least now you know what slippage is all about. But I guarantee you that won't stop you getting frustrated when you fall victim of slippage. We all do from time to time. At least now you know the certain conditions to best avoid. Now, if you like the video, give me a thumbs up, give me a thumbs down. If you didn't, don't forget to leave me a comment now. Let me know if you've fallen victim of some really horrific slippage in the past. Don't forget now, you can follow us on all the socials and subscribe to the channel if you don't already do so. You know, we're dishing out these videos now a couple of times a week. If you hit that bell notification, you'll be notified the moment the next one hits the wires. Now, we are streaming live around the clock, up to 7 times a day, 5 days a week. If you want to take part in that, you can do so. Just follow the link in the description tab below as well. Until next week, have a good week.